Understanding Capital in Small Businesses. This video is brought to you by the Office of Minority and Women's Business Enterprises, with support from the Department of Financial Institutions and Community Bankers of Washington. Let's take a look at capital, the funds you use to launch your business or keep it going on a long-term basis. In a new business, you use startup capital to cover initial costs like buying equipment or inventory. These funds help you meet expenses until the business becomes profitable. Startup capital could come from your savings, a home equity credit line, or a family loan. Or it might come from outside sources, such as financial institutions or investors. In some cases, startup capital comes from a combination of sources. Once the business is running, you use working capital to cover day-to-day operations costs. These include things like payroll, overhead and recurring bills, marketing or advertising, and new inventory purchases. Ideally, working capital will come from business revenue, that is, from sales of the company's products or services. To calculate your business's working capital, add up the total of the business's current assets. That's the total of the cash balances plus assets that you expect to turn to cash within the next 12 months. Then, subtract the business's current liabilities, the total of its debts and obligations that must be paid off within 1 year. Other business assets include business property and inventory. What if you need more working capital? It's not surprising that some businesses need additional investors or a working capital loan to help with cash flow. This is especially common in the first year or two. If you have to borrow from a lender, such as a financial institution, the lender will require specific information about your company's structure, worth, and operations. Lenders will want to know how much capital and assets the owners or investors have put into the business, and how much money has been borrowed. The relationship between the two is called the debt-to-worth ratio. It's an indicator of the business's financial strength, which means its ability to absorb short-term losses and still meet its debt repayment obligations. To calculate the ratio, divide the total liabilities by the total assets. Here are two examples. A company with $20,000 in debt and $10,000 in tangible assets has a debt-to-worth ratio of 2. One with $16,000 in debt and $4,000 in tangible assets has a ratio of 4. Lenders also evaluate working capital as a ratio, similar to the debt-to-worth ratio. To determine the working capital ratio, divide the business's current assets by its current liabilities. If the company's debt is high compared to its invested capital, a lender might decline a loan request. That's because the lender would have more at risk than the business owners or investors do. Generally, the lower the debt-to-worth ratio, the more attractive the business is to lenders. Different lenders have different acceptable debt-to-worth ratios. A lender that participates in the U.S. Small Business Administration's Loan Guarantee Program might allow a higher debt-to-worth ratio than one that doesn't, for instance. If you think your business will need a working capital loan, it's smart to research potential options and target ratios before you start discussions with lenders. For more detail or specific business guidance, reach out to industry experts. Your local financial institution, an accountant, or counselors at the Small Business Administration or SBA can be helpful resources.